A very good morning to all of you students. My name is Sev Devas Gupta and today we will be continuing our discussion on the live virtual classes, revisionary classes on the topic of interest rate risk management, and then we will also be covering the mergers and acquisitions. So students, let's start with the topic of interest rate risk management. So in our previous session, we have covered about why there is a need to pay or receive interest. So we said that there are because of two reasons. One, the interest is on account of time value of money, because as the time passes, the value of the money, it changes, and it is also called as inflation that we say. And the second reason why the interest is charged or paid is because of the risk that the other person is carrying. For example, if I lend someone some amount, so there is a risk of non-recoverability of interest as well as the non-recoverability of principal. To cover up that risk, interest is paid. Okay. So these are the two broad reasons why we kind of pay the interest. Now we also discussed that in the context of market, in the context of credit market, where the credit is given or taken, loan is given or taken, the interest rates are dynamic. They keep on changing, and they keep on changing through how? Through the market forces of demand and supply. So let's say today the demand of the credit is high, the interest rates also will become higher. Similarly, the supply of credit becomes high in the market, the rate of interest becomes lower. So, because of these changes in the interest rates, it leads to the interest rate risk. What is the interest rate risk, students? The interest rate risk is the risk of change in your assets or liabilities base, or we can say the net interest income. We will come to what is meant by net interest income. So, if interest rate changes, it leads to some of the changes of the numbers that you report in your balance sheet and P&L. That is why there is a interest rate risk that arises. And to cover up that risk, to mitigate that risk, whatever techniques or strategies we are using is called as interest rate risk management. So we will cover up what are those specific strategies. Okay. Now, if you recall in our previous session, we said that the interest rates are bound to change, which is fine. However, in this specific example, let's say you have invested into a investment which is linked to the market interest rate. Okay. And similarly, you have taken a borrowing which is also linked to the market interest rate. Now, if tomorrow the interest rate changes, whether it increases or decreases, it will definitely impact your interest income and interest expense on both the sides in the P&L, right? On both income and expenses side, it will impact your interest item. And how do we define net interest income, students? Net interest income is actually defined as interest income minus interest expense. Okay. So this is a term which is much more relevant in the banking sector, wherein they will try to see, okay, what is the net interest income being generated? And this net interest income will have a dependency on the interest rate movements. Now, if you know how to curb the risks, okay, then you will be able to manage this net interest income risk better. It should not happen that because of the interest rate changes exposure, the net interest income might fall. So that's the overall objective to avoid. Okay. Now, what are the techniques to manage the interest rate risk? That is called as hedging the interest rate risk. So, students, in our previous session also for the derivatives, we discussed, right? So, hedging will mean that how are you managing the risk that is already existing with you, right? So, we discussed about hedging with the use of forwards, futures, and options. Similarly, this interest rate risk, how are we going to hedge? So there are two ways. One is a traditional method, and second one is the modern method. So these are the two broad categories into which the hedging part of the interest rate risk is bifurcated. So the first part is traditional method, students. Under traditional methods, there are again two different methods. One, there is a asset and liability method which is called as ALM, and second one is called as the forward rate agreement, which is also called as FRA, forward rate agreement. Okay. Then within modern method, students, there are three sub parts. One, there is interest rate futures. These are called as IRF. Then there is interest rate guarantees, IRG. And then there are interest rate swaps, which is IRS. Okay. So these are all different instruments that comes under the modern methods. Okay. So with all of these concepts or instruments, the underlying idea is one, that how can we get to the interest rate risk management. Okay. Now let's discuss these methods in detail. So the first method is asset and liability method, ALM. So we are starting with the traditional method, students. Okay. Now if you see, students, in any of the business, there are assets and liabilities, right? Now these assets and liabilities are receivable in cash and payable in cash, right? Liabilities are payable in cash, assets are receivable in cash. By cash, I mean the money, right? Now, these assets and liabilities have different maturity profiles. For example, some of the assets will get mature or for the realization in the next 90 days. Similarly, some of your liabilities will get matured in terms of your payment within 120 days, right from now. So, in a way, what is happening, students? Your amount will be realized on 90th day, but you will be end up paying on 120th day. That means for 30 days, the funds will sit idle. And let's assume these are the only two assets and liabilities that are existing. So for the balance 30 days, the funds will sit idle. Okay, now what will happen? For these 30 days, the company has to decide what needs to be done with the money, because the funds cannot sit idle. So the idea here is that after 90 days, there are two, three options. Okay, one, it can be invested for another 30 days, and after 30 days, the realization can happen, and then it will be used to pay to the suppliers, to the vendors. That is one. Second, you may also connect with the supplier to say that, okay, instead of 120 days, I will pay you in 90 days, provided you give me a cash discount or you give me a discount for 30 days that I am prepaying you. Okay. So these are the possibilities. So this is something which is in which you are trying to match the timing of your cash inflow and outflow, right? You're trying to match your assets maturity with the liabilities maturity, and that is where this is called as the asset and liability method. Yes, it's a kind of netting technique. So yes, Saminathan. So this is something which is called as a technique in which you try to net and see definitely on one day that these are your liabilities and assets, but then you also consider that what are the other maturity profiles of your liabilities and assets. Clear? Now with this, what have you done is you have tried to match the maturity dates of your assets and liabilities, and hence you have tried to reduce the risk of investments or borrowing. Now in my previous example, we tend to invest that amount for short term purposes, but there can be other situations also. For example, the cash discount thing that I spoke about, right, wherein the supplier will be requested to accept the money earlier and pay some cash discount. So in a way, you are trying to mitigate any impact on account of the interest rate risks to you. Similarly, there can be many other things. For example, w- in the negotiation itself, there is a 90 days collection period, but the vendor is not agreeing to give you more than 60 days of credit period. So then what you will do? Then again, maybe you will negotiate with the vendors that if you give me 90 days credit period, so this is going to be the commercial, correct? So in a way, you're trying to again match your lower liability period to the higher realization period. So all these efforts, all these kind of initiatives are within this category of asset and liability method. And the underlying principle here is that the more your assets and liabilities maturity profiles are aligned, the less risk you are undertaking. Okay. Then the second method comes as the forward rate agreement, students. So now this is something very, I would say, interesting and also important. So there are two banks, Bank A and Bank B. Now Bank A needs to borrow not today but after 1 month for 3 months. So this is the situation, students, wherein Bank A needs to borrow after 1 month at the rate of rupees 1 lakh. Bank B needs to invest after 1 month for 3 months after 1 lakh. So you see, both the banks have opposite positions. But the factual thing is they want to borrow or invest after 1 month, and their ticket size is also same, which is 1 lakh rupees. The duration is also same, which is 3 months. Okay. Now, so there are two, three options to them, right? One, they cannot execute the transaction today because definitely the need to borrow or need to invest is after 1 month. So they can enter into a commitment today. Okay. They can enter into a commitment today. Commitment at the rate, which rate will be applicable of interest, right? Commitment that after 1 month the funds will be borrowed and invested respectively. So all these commitments they can make. Now the question is at which rate the commitment will happen, because the current interest rate is 5% per annum. The forward interest rate is 6% per annum. For example, they have agreed to this 6% per annum. Why it is different from current interest rate? Because in future the interest rate is bound to change. It might go up or it might go down, right? But let's say they have an anticipation that the interest rate might go up. That's where they are agreeing. Instead of 5%, let's lock it at 6%. Okay. We will come to this how this 6% would have also been derived while we will go through the valuation of the FRAs. Okay. Now, as on today, what has happened? The deal is entered. So there is nothing in terms of the outflow or inflow of the resources. It's only just that the commitment has been made, the deal has been entered. Then, after 1 month, okay, is when the actual execution of the deal will start. So here the deal is executed. Let me also tell you one more thing, students. There is a way we denote the FRA. There is a specific way we denote FRA. So FRA 1 by 4 will mean what? FRA 1 by 4 will mean that the forward rate agreement will start after 1 month and end after fourth month. Correct? Yes. And the duration will be calculated as this 4 minus 1 is equal to 3, which is the 3 months. So that will be your duration. So, FRA 1 by 4 will mean that FRA will start after the first month and end after the fourth month. Okay. And hence the duration will be 3 months. So this is what we have depicted here. First month it will start, fourth month it will end, and hence the duration will be 3 months. Now, FRA 3 by 6 will mean what, students? Come on, tell me. FRA 3 by 6 will have when it will start and what will be its duration. Yes, Lavanya, you're right. Saminathan, you're also right. Perfect. So this will start after 3 months and the duration will also be 3 months. So 3 by 6. Okay, then the FRA 12 by 8 students, again with the similar logic. After 1 year it will start, after 12 months it will start, and it will continue for 6 months. Clear? Okay. Then now let's come to the FRA conditions that they have entered into. Now Bank A has entered into a borrowing position. Yes, you're right, Saminathan, and you're right, Lavanya. Then Bank B has entered into the investing position, students. FRA 1 by 4 has been entered, right? After 1 month for 3 months. And we are talking about 0th period here, which is the period in which they have entered the transaction. The first month, students, is when the actual interest is, let's say, 8%. Okay. So what have they entered at 6%? Now see, how will Bank A think? Again, the same logic that we have discussed in our derivatives, right? If your agreed rate is compared to the actual rate in the market, then what differences it will lead to? In this case, the actual interest rate is 8%. Now see how Bank A will say, okay, I have a commitment to borrow at 6%. The market interest is 8%. That means I am benefited by 2%. Correct? Because the commitment is at a lower rate than the market rate of 8%. So there is a gain of 2% here, students. Similarly, for Bank B, if you see the Bank B, there is a loss. Why? Because Bank B will say, I have a commitment to invest at 6%. I will get a return of 6%. However, market interest rate, I would have been able to invest at 8%. So 2% I am having a loss because of this commitment. So there is a loss of 2%. So can you make out how can we calculate the gains or losses for Bank A and Bank B respectively, right? So the loss will depend on whether your market interest rate is higher or lower. If you are into the investing position, so if the market interest rate is higher than your committed rate, then you are at loss. However, if your market interest rate is lower, which is our next example, then let's see how it will happen. So let's say the actual rate is 5.5%, students. So for the borrowing bank, if the borrowing bank would have not entered into this commitment to borrow at 6%, then the bank A would have borrowed at 5.5%. Correct? So hence there is a loss of 0.5%, students. Correct? Because the bank A is borrowing at a higher rate of 6%. Similarly, if there is a if there is a discussion from the perspective of bank B, so bank B is the investing position. 5.5% is the actual rate, 6% is what they will be going to invest. So because of this commitment, there is 0.5% gain that has come to bank B. Okay. Now, in the overall story, case 1, bank A would get 2% and bank B would pay 2%, which is the differential amount. So how the calculation will happen? This is the notional amount. So 8 minus 6% is the differential amount for 3 months. Correct? And since the settlement will happen on the first month itself, here, that's where they will do the present value of this gain as well. So which is divided by 1 plus 8% into 3 by 12. So 8% is the actual interest rate. On that, the present value will happen. So the net gain from Bank A's perspective is 490.19, which will be received on the first month, and Bank B would pay 490.19 on the first month itself. So this is actually the present value at the start of the loan. Okay.
So can
Okay.
you explain this present value calculation here?
Okay. So if I say what is the gain in the overall duration, let me put it here. So we have like this 0 and 1 month. Then after 1 month we have duration of 3 months. Okay. So that means fourth month the loan will end. Now just if I just ask you to calculate what is the gain on this 3 months period, so that will be 8% minus 2% into, since this percent, sorry, 8% minus 6% into 3 months by 12 months. For 3 months, the gain will be 3 by 12, right? 8 and 6 is the annual percentage multiplied by 1 lakh. Correct? This is my overall gain of 2%, but this gain is as good as a gain on fourth month, right? Because if I say this overall amount becomes due to me on fourth month, so let's assume this comes out to be uh, 2000 into, I think,
500, sir.
500 rupees. Yes, 500 rupees. Okay. Now, if this is a 500 rupees, it comes out receivable on the fourth month. But reality, the settlement happens here even before we start the duration. So this 500's present value will be computed as, now here there can be a question whether we take the 8% or the agreed rate of 6%. We will always take the actual market rate. Whether it is higher or lower, the present value will happen basis the actual rate. So 1 plus 8% into 3 by 12. That's what the formula is, and it will result to 490.19. Okay,
Thank,
clear?
thank you, sir.
Yes, Saminathan, you're right. We are bringing the rupees 500 future value to the present value. Okay. But at the same time, students, one more point here. At the same time, sometimes the question might ask you to calculate the value on the fourth month itself. Then please specifically calculate the value after the fourth month. Okay. Then don't calculate the present value. So that will be clearly specified. If nothing is specified, then always calculate the value on starting of the loan. Okay. Clear? Then let's come to the second case where bank A will pay zero point 0.5 and bank B will receive zero point 0.5. So here what is happening, students? Here on this 1 lakh rupees, 0.5% into 3 by 12 is what we will be generating. And again, divide by 1 plus 5.5, which is the actual rate for 3 months. So this will lead to 123.31. Correct? So again, the present value to be taken basis the actual rate. Bank A would pay 123.31 to Bank B in case number 2. Okay. Now this is the formula, students. If we see, N means the notional amount or principal amount. Why are we calling it as notional amount? The why we are calling it as notional amount is because in most of the cases, the FRAs are settled on a net basis. If they are settled on a net basis, the amount of principal is neither given nor taken. Hence, we call it as a notional amount or a reference amount at which the amount is calculated. Clear? Then, RR is the actual rate of interest, FR is the forward rate of interest, and T is the time period, right? So forward rate is the committed rate, students. That was 6% in our case, right? And RR, which is the actual interest rate, will keep on changing. Okay. Now, if there are two banks, Bank A and Bank B, Bank A is a borrower and Bank B is a lending is into the lending position, this is very, very important to see which bank will be gaining or which bank will be losing depends on their positions, right? Now, if bank A is into the borrowing position, we always call them as a purchased FRA, right? So they have purchased the FRA. Like in case of derivatives, for forwards, futures, and options, where the underlying was a share, it was very easy that who has purchased and who had sold, right? But in this FRA case, we always say the borrower is having a purchasing position or a long position, wherein if the interest rate goes up, the market interest rate goes up, the gain also goes up. And here, if the interest rate goes down, the gain also goes down. Clear? And if we talk about Bank B is into the lending position. So here we call it as the bank which has sold FRA short position, where if the interest is higher, the gain is lower, and the interest is lower, the gain is higher. Okay. So these are called as the lending positions. So all the thought process, whether you have purchased the FRA or you have sold the FRA, will be different, and your gains and losses will be different in the different situations. So the way to read is long position always means it's into the bank is into the borrowing position, okay? And sold FRA or the short position means the bank is into the investing position or lending position, okay? Clear? Any questions, students, till now? Any questions, students? Please do let me know, or else we will move ahead. Okay. So the next part now, students, is the valuation of FRA. So the how do we really value in terms of the pricing of these FRAs? Okay. Okay. I think there is some question on the query handle from B. Kiran Kumar. In between, there may be some foreclosure for that. How to handle? Okay, you're talking about the loan here. In case if there is a foreclosure, then definitely they will have specified their specific terms and conditions. Okay. In between, if there is a foreclosure, then they would have specified that what will happen because of the foreclosure. Yes, I think your answers are correct, Kiran. Yes, the actual investments, as I said, that mostly it will be happening on a net basis. Okay, but sometimes it might happen on gross basis as well. So that will also depend that you have entered into a OTC contract, correct? Again, the same concept from forwards and futures, because forwards are over the counter contracts. That means you can specify these terms and conditions clearly over there, and you can get it executed as well in its gross basis, which is the gross lending and gross taking, right? Investing. However, the futures are standardized contracts, and hence they are always settled net. That's the position that we understand from derivatives. Similarly, in interest rate risk management, the FRA is the forward rate agreement, right? Where the settlement mostly happens on net basis, but sometimes it can happen on gross basis as well. Okay, formula I have explained. Yes, Kiran, this is, you can send the questions. I will check and let you know on that. Okay. Okay, perfect. So let's come to valuation of FRA. So valuation of FRA is FRA. Let's take an example of 3 by 6. So 3 is the starting point and 6 is the ending point. Okay. So 3 is the starting point and 6 is the ending point. That means duration is for 3 months. The loan will start after third month. Okay. Now, students, if you see, just like there is a future rate that is available on an equity share, right? For example, the underlying equity share is 100, the future rate is available at 105. That means in future, the price of the equity share would be trading at 105. That means this, but technically this is the present value and future value difference. So 100 is the present value, which is the spot price, and 105 is the future value, which is the future price. Now if you see from interest rate perspective as well, there are two different kinds of rate. One which is the actual rate which is appearing as of now. Second, there is a future rate as well, which is going to appear on the date of that rate that is specified. For example, there is a rate that is specified at 6 months, there is a 5% per annum interest. Okay, so let me kind of explain you. Okay, hold on. So, for example, there are for different maturities, okay, for different maturities, there are different rates. Lower maturities have lower interest rates, higher maturities have higher interest rates. Now, this 3 months, 4% per annum will mean that a loan which is having a duration of 3 months from now, okay, I'm not talking about a future rate here, I'm only talking about the current rate. So, current, if I start for 3 months any loan, the interest rate that would be applicable to me is 4% per annum. Okay, this is per annum rate. It will be converted into 3 months, like 4 into 3 by 12, right? Similarly, if the duration is for 6 months, students, that means the loan will continue for 6 months from now. The interest rate might be higher. Similarly, 9 months it might be slightly higher again. 1 year, let's say it is 6% per annum. Okay, and then 10 year it becomes 7.5% per annum. This you would have also seen while you book any, let's say, fixed deposits with the bank. So the higher maturity will give you a higher yield. Okay, that's the general way market behaves. Can anyone tell me what is the reason for this? What is the reason for this general phenomena where the rates becomes higher depending on their maturity? Yes, very good, Lavanya. You're right. Because the higher time you give a loan for to someone, yes, Shalendra, you are also right. Okay, so this actually comes from the first sheet that we discussed here. So interest is paid on account of two things. One is the time value of money, and second is the risk. Okay, if the time considered, or let's say the duration is higher, that means the risk is also higher, right? That means the risk is also higher, because then the risk of non-payment is actually running for higher time, and hence you will expect a higher amount of return. Okay, now since market will quote you different interest rates basis their different maturity profiles, we can calculate the future interest rate that we were talking about. Yes, Saminathan, you're right. Less time, less risk. Long time, longer risk, which is fine. So, what I'm saying is, you have interest rate, let's say, for 0 to 6 months, which is continuing as on today. You have interest rate for 0 to 3 months, which is again in existence as on today. Now, what you want is between 3 months to 6 months. That is the future interest rate that you want. As I said, that this future interest rate is something that you can compute today basis the 6 months and 3 months maturity. The question is how. Let's say the 6 months maturity rate is 5% per annum, and 3%, 3 months maturity rate is 4% per annum. Okay. Then we can assume this to be x and we can just simply put in an equation to calculate this. So 1 plus 5% is for 6 months into 6 by 12, right? Is equal to 1 plus 4% into 3 by 12, which is the 0 to third month. Okay. Multiplied by 1 plus x percentage into 3 by 12. So that means we are trying to equate the 6 months interest value to the 3 months into another 3 months interest value. The reason being because the market will always operate on equilibrium. Okay. If there is a difference in this equation, okay, if there is a difference in this equation, it will lead to many arbitrage opportunities wherein a person can, let's say, invest for 6 months and then borrow for 3 months, and next 3 months also the person can borrow. We will come to those arbitrage opportunities, but the question here is that why are we equating these two amounts? And please do remember, here we are multiplying, students, because after 3 months, so let's say you have invested for 3 months, then after 3 months your investment will be compounded for another 3 months, right? So this helps to compute the x percentage, which is, let's say, in this case computed as 5.94 percentage. So this is 0 to 3 months interest, this is 3 to 6 months interest, and this is 0 to 6 months interest. Clear? So in totality we are targeting this equation to calculate the future interest rate. I hope this is clear, students. We also call this computation as the theoretical minimum value. Why theoretical minimum value? Because in theory, this is the minimum value that we can expect. Okay. Now, let's talk about the arbitrage opportunities. Okay. The first one, if FRA is available lower than 5.94. Now, this is something calculation as per our metrics. Now we will compare that what rate FRA is available, right? In the market, what rate FRA is available. So if FRA is available at lower than 5.94 percentage, okay, so if FRA 3 by 6 is available at lower than 5.94 percentage, then we call it as FRA is underpriced, correct? So what happens, students, if I think the value is 5.94 but in market it is available at 5.9, that means the FRA in market is underpriced. If FRA is underpriced, then what will happen? We take a long position in FRA, students, right? And hence we borrow through FRA. Correct? This is a general phenomenon, students, where we know that wherever there is a there is anything that is underpriced, we always purchase it. Where anything is overpriced, we always sell it. So if this is underpriced, we take a long position, and long position technically means that we are borrowing through FRA. Okay. So we are here 0 to 6 months, right? Now borrowing through FRA means if third to 6 months we have to borrow, then 0 to third month also we have to borrow. Correct? 0 to third month also we will have to borrow. And then 0 to 6th month we will have to invest. Clear? So third to 6th month we will have to borrow. 0 to 3 month also we will have to borrow, and we will have to invest for 0 to 6 months. Right? Why? Because we will have to take the opposite position in the overall duration. whatever position we are taking under FRA, we will have to take the opposite position. Okay. Now, borrow for 3 months. Okay. This is our technically the stand. As on today, we will borrow for 3 months, and we will also purchase an FRA of 3 by 6. Again, I am repeating, we will also purchase an FRA of 3 by 6, and then we will invest the borrowing that we have done today for 6 months. So borrow 3 months, let's say we borrowed 1 lakh rupees. Okay. And that's maturity is 1 lakh 3,000 after 3 months. So this 1 lakh 3,000 becomes our FRA notional amount that we will have to borrow, that we will have to purchase after third month. And then the maturity of the FRA is 1 lakh 6,000. Clear? So invested 1 lakh for 6 months, and in the investment we will get, let's say, 1 lakh 7,000. So there is an arbitrage opportunity that on the investment proceeds we will get 1 lakh 7,000. On the maturity of this FRA, we will have to pay 1 lakh 6,000, and hence on a net basis we get 1,000 rupees as arbitrage, as a sure shot profit, as a riskless profit. Okay, so arbitrage means that you are taking the benefit of differences in the exchange rate in two different markets. Not here exchange rate, but the interest rate, sorry, the interest rate in two different market. Okay. Now, where the FRA 3 by 6 is overpriced. So let's say this is higher than 5.94. If the FRA is overpriced, then what we will have to do? We will have to short sell the FRA, or we will have to take a lending position, or we can say we will have to invest through FRA, students. Right? And it will happen how? So if something is overpriced, we will sell. That means here, this 3 by 6, we are investing through FRA. Then 0 to third month also we will invest, and 0 to 6 months we will borrow. Okay. Borrow for 6 months, investment will happen for 3 months, and another investment will happen through selling the FRA of 3 months. That is 3 by 6. Clear? As we discussed, students, there are two ways to settle, or let's say two ways to enter into this. One is the gross basis, second one is the net basis. In the net basis, we will be paying or receiving net, right? The formula we have already discussed. Gross basis, students, is the actual borrowing or lending at the rates at which are specified in FRA. Okay. So here the actual gross amount will be paid or received, and the borrowing will happen at the rates that are specified. I hope this discussion is clear, students. So first of all, the valuation of the FRA is clear. And secondly, apart from the valuation, the arbitrage opportunities, how we compute them, is also clear. In case you have any questions, please do let me know, students. Let me take a quick pause and check if there are any questions. Okay. Now let's start with our next topic on interest rate futures. Interest rate futures, which is also called as the modern method. Within the modern method, this is the first method, interest rate futures. Now, interest rate futures are certain financial, financial, I would say, instruments which are actually dependent on the bond prices. So let's say the bond prices are always inversely proportional to the interest rate changes. This is the fact that we know, correct? So the interest rate changes. If interest increases, the bond prices decreases. So this we have also touched upon in our previous sessions. And if the interest rate decreases, the bond prices increases, right? Now, if interest rate increases, the there is a if let's say we want to gain if the interest rate increases, or if we want to gain if the interest rate decreases, we can definitely link it up with how should we sell the bonds futures or purchase the bonds futures in case we need it. Okay, if you want to say that if the interest rate increases and you want to gain, which position you should take. So you want a situation where if the interest rate increases, you gain. If the interest rate increases, then you will do a short selling of the bonds futures. Just do remember, general phenomena is that if the interest rate increases, we take a long position, right? That would have been true if they are directly proportional, but reality they are inversely proportional. So you will have to short sell the bonds futures. Okay? Because tomorrow, if the interest rate increases, the bond prices will decrease and you will be able to gain in case you have taken a short sell. You have already sold the futures, then only you will be able to gain. Correct? Similarly, if interest rate decreases and you have to gain, then you'll have to take a bond futures long position. That means you will have to purchase a long position in bond futures. So students, you might be thinking, why are we relating the interest rate futures to bonds? The reason being, in market there is no specific product on the bonds futures. Sorry, there is no specific product on the interest rate futures. The specific product is always on the bonds futures. Okay, perfect. So this is what about the interest rate futures is. Now let us, okay, we will draw the comparison after we cover the interest rate options or guarantees. Okay, then we will draw the comparison with the forward futures and options. So till now, students, if I just make you recall, we have discussed about ALM, asset liability method, right? In which you try to match your liabilities maturity with the assets maturity. Second, we have also discussed about the forward rate agreements, which is as good as that you enter into the contracts today to lend or borrow after some time from today. That is forward rate agreements. Third, we have also discussed about the interest rate futures, wherein we are linking the interest rate movements with the bond prices to come up whether we need to short sell or purchase. Okay. Now let's talk about the interest rate option slash guarantee. Let's first of all talk about call option, students. So the call option, sorry, cap option. So let's say A is a contract. Okay, A is a contract. Let's say a right, a privilege, but it's not an obligation. Again, we are repeating the discussion that we have had on the options in futures, options in derivatives, right? This is an interest rate option that we are talking about. So here also, let's say that A is a contract. Now, contract of what? To borrow, right? There it was a contract to buy. If we talk about the call option and the cap option here. So here the cap option is a contract to borrow. That means I am into the borrowing position, a specified amount, which is a notional amount. This is a specified notional amount at a specified interest rate. The interest rate is defined in that agreement on a specified date. On a specific date, it will be taken up, which is from a seller or investor perspective, right? So, in a way, this is helping us to lock the maximum rate at which we can borrow, right? And why we are calling it as a right? Because we have an option. Today, if we don't want to borrow through the cap option because of the situations appearing in the market, we can avoid doing that. And what are those situations? Let's say the specified interest rate is 8%, the market rate is 6%. Now tell me, students, whether you would want to borrow through FRA or whether you can go to the open market and directly borrow in the open market. Yes, Lavanya, you're right. Should we go to the open market and borrow? The answer is yes. However, if we are talking about the similar situation in forward rate agreement, then do you have this option? Let's say your forward rate of agreement is 8%, your market rate is 6%. Yes, very good, Sachi, you're right. So the similar situation is here. You're agreed. FRA is this much, but actual market rate is this much. Very good, Saminathan. So in case of an FRA, it's a committed situation wherein you cannot go back and say that I have an option. If I don't want to get into it, I will not get into it. It's not the case. However, in a cap option, since the term itself says an option, there is an option. If the situation is favorable to you, you will exercise it. If the situation is not favorable to you, you will not exercise it. So you're right, Saminathan and Lavanya, you're right. In both the cases, there will be a this limited difference. Now, don't you think that okay, let's come to the parties first, then we will go there. Then there is a buyer, holder, borrower, similar to the financial options that we have discussed, and then there is a seller or investor who is going to invest, right? Who is going to write that option, and there is a buyer, holder, or a borrower, students. Now the buyer will become the actual borrower on execution, and the seller, or let's say the investor, will have to invest the amount in case the option is exercised, right? So I think this position is clear. Now in case of a cap option, the holder or the buyer becomes the one who actually wants to borrow, and similarly the seller or the investor is the one who will become later on, who will actually be investing this, right? Then the second comes as the floor option. Now the floor option is again, everything is similar subject to the fact that again A is a contract right privilege which is not an obligation, but here the only change is to invest. The idea here is that the holder wants to take a investing position at a specified amount at a specified interest rate on a specified date. Okay. Yes, Saminathan, you're right. So in case of this, the holder or buyer becomes the investor, students. Okay. And here the seller of the floor option becomes the borrower later on. Because if the right to invest gets exercised, the person who has written this floor option will have to invest, will have to borrow. Okay. Similarly, the holder of this floor option will have to invest. Clear? Now, this floor option will guarantee you a minimum return on your investment. Guarantee minimum return on your investment. Why? Because the rate, if it goes below this specified rate, if the market rate goes below the specified rate, through this option, you can still recover up to that rate at which you are trying to invest, right? However, in case of a cap option, there is a specified interest rate, which is the maximum rate you can pay if you want to borrow, right? So, guarantee maximum interest on your borrowing. So, this guarantee maximum interest on borrowing. Because as a borrower, you will want that the maximum amount that we are going to pay should be fixed, which is happening through this cap option. So if you see, cap means they're putting a cap to it, that this is the maximum amount of interest that you need to pay. Similarly, floor option is the one where you are giving a guarantee of the minimum return on your investment, right? Now, since we are talking about one person giving a guarantee to another, so the writer, in both the cases, writer is giving guarantee to the holder. So holder will have to pay premium to get that guarantee. So this is what this is basically an option, guarantee in the form of an option, right? So the writer is giving holder an option. So the holder will have to pay premium to the writer. Just very similar to what we have discussed in derivatives, right? About the financial option, students. Okay. Now how this premium Now, this premium will always be paid by the buyer and it will be received by the seller. So, the cap, the borrower takes the buyer of cap. For floor, investor becomes the buyer of the floor option. Similarly, here, investor becomes the seller of cap option and borrower becomes the seller of the floor option, because ultimately they will be getting into this specific positions. Clear? Then let's come to the different payoffs for buyer and seller of cap and floor option. So let's talk about a cap option and a floor option. So the cap option is for holder or buyer right to borrow. It gives you the right to borrow. And for the holder or buyer of a floor option, it gives you a right to invest, wherein you can invest, right? Here, there is a strike at the rate of strike rate of 10%. Here also, let's set the rate of strike rate of 10%. That's the specified interest rate. So the maximum percentage that you will be charged in case you want to borrow is 10%. The minimum percent that you will be given as a return is this 10%. Then you also get into the premium. Let's say 1% we have specified that there is a sunk cost of it, because you will just pay and then it will not be adjusted later on, right? The premium is always paid. So this is basically your premium on both the cap options and the floor options. Then let's talk about the actual interest rate, students. So the actual interest rate is, let's say, 12%. That's the first case. So now, without getting into the discussion, tell me, the cap option where there is a right to borrow at 10%, the market interest rate is 12%. Tell me whether there is a gain or loss to the holder or the buyer because of this option. Yes, Lavanya, you're right. Prashant, you're right. Perfect. I request everyone to please respond on the chat box. There is a gain of 2%. Why? Because had this option not been there, the borrower would have borrowed at 12%. Now, because of this, the borrowing is happening at 10%. So there is a 2% net gain, right? Let's talk about floor option, students. In case of floor option, there is a right to invest. If the actual interest rate is 12%, the strike rate is at 10%. Then ultimately, what is happening to you? You can invest at 12% and you have a option to invest at 10%. So whether you will invest at 12% or 10%, students, you will definitely go and invest at 12%, correct? So that means this option is not exercisable as of now, because you will just go and take the actual investment at 12%. But now the question comes whether you are at a loss of 2% or not here. Whether you are at a loss of 2% or not here. Can I say that there is a loss of 2%? Yes, very good, Saminathan. Very good, Lavanya. Prashant, there is no loss of 2%. Why? Because you will just go and invest at 12%. Right? That means you are capturing the market possibility within your decision. Yes, you're right, Sachi. So, what is happening here is that at 12%, there is no loss that you are getting. Okay? However, so this is 2% gain and 0% loss. However, if this is a situation on forward rate agreement, then I agree. This there would have been a 2% loss here. But since this is not a forward rate agreement, you have an option to invest through this option. Hence, there is no gain. There is no gain, no loss. Only thing, whatever premium you have paid early becomes a loss. Case number two, students. If the actual rate of interest becomes 88%, now this is relatively easy, right? 88%. So in case you are in the cap option buying position, that means you will end up buying it, you will end up borrowing at 8%. However, you have an option to borrow at 10%. So you will ignore that option of borrowing at 10%, correct? Because your interest in the market is already lower. Similarly, if you have a floor option, sorry, is there some any question? Okay. So in case you have a floor option, then what is happening? You have a option to invest at 10%. The actual market rate is 8%. Tell me whether you will exercise the option or not. Definitely you will exercise the option. Okay. Sorry, there is some question. Somebody has unmuted. In case there is some question, please do ask. Okay. So this is what we were trying to say, and this is the basic difference between the forward rate agreement and the interest rate option, students. Clear? So here there is no loss. As I said, that loss cannot be there in interest rate guarantee. It can always be a gain from the holder's perspective. Okay. But from a seller perspective, there can be a loss, right? Perfect. So this is the comparison that I was talking about, students. So in case of forward rate agreements, so this is what this is all about, the interest rate risk management. These are all the topics of interest rate risk management. So the forward rate agreement is as good as forward contracts in derivatives, students. Second, interest rate futures is as good as futures. Then interest rate options, whether it is a cap or a floor, is as good as options, call or put. Correct? Call option and put option in financial options, right? Financial derivatives. And here it is to borrow, here it is to buy, here it is to invest, here it is to sell. So put option is to sell, floor option is to invest, and both of them involve premium. Clear? I hope this comparison is clear, students. Perfect. Now, this is something that I want all of you to understand from a normal concept. For example, any borrowing or investment, students, that happens right in the market, it can happen into two different ways. One, it can happen into a fixed rate of interest. So let's say there is a loan of, let's say, automobile loan. Okay, there is a automobile loan, there is a car loan somebody have taken. It generally is a short term loan and it happens on fixed percentage, which is, let's say, 10%. On the other hand, somebody has taken a housing loan. The housing loan is a higher tenure, so it happens on MIBOR plus 1%. MIBOR plus 1% means, so this MIBOR is specifically a benchmarking rate. It's a reference rate to the market, which means that whatever market quotes this MIBOR. So, for example, this is Mumbai interbank offered rate. So whatever is within the banks in within Mumbai market, the dealing is happening, the lending or borrowing is happening. So the average of that rate is quoted as MIBOR. Okay, so this is MIBOR plus 1%. So this is MIBOR, which is the interest rate at which the banks borrow or lend within the banking industry. So this is another way to quote your floating rate of borrowing or investment. Now, let's say today MIBOR is 8%, so your overall interest rate becomes 9%. After 3 months, the MIBOR, let's say, becomes 10%, so your overall rate of interest becomes 11%. So what you are doing is you are adjusting your interest rate on your borrowing or investment basis the actual rate in the market. Correct? So these are the two different ways you can define your interest, whether you talk about a borrowing or investments. Now, let's come to interest rate swap, students. Okay. Interest rate swaps is the last, I would say, technique in the modern method which is used to mitigate the interest rate risk management. So let's understand with this example. This is a very good example. There are, let's say, two companies, company A and company B. Okay, there are two companies, company A and company B. Company A is actually a well established company. Okay, and they want to borrow in floating. They have a preference to borrow in floating because they're well established, their P&L and cash flows are very stable. In case there is a risk of upside for the floating percentage of borrowing, they can also manage that. But at the same time, since floating will help them to be mark to market, so any gains or losses within the market can also flow to them. So they are very clear in their strategy, they want to borrow floating. Company B, on the other hand, is a new company, students. Okay. So let's say company A was well established company, company B is a new company. So they prefer to borrow in fixed. Okay, they prefer to borrow in fixed. Reason being, they don't have much risk taking appetite. So tomorrow, if the rate of interest goes up, they will not be able to basically absorb that. So they have a clear strategy, they want to borrow in the fixed percentage. So they approach their respective banks, Bank A and Bank B, students. Now, Bank A has quoted to Company A that in case you want to borrow fixed, I will pay you 7%. You are required to pay me 7% interest. If you want to borrow in floating, I can offer you a MIBOR equivalent rate itself. Okay. Similarly, the Bank B of Company B again says that in case you want to borrow in fixed, I will charge you 10%. In case you want to borrow floating, I will charge you MIBOR plus 1%. So you see the differences in rate. These are on a lower side and these are on the higher side. Okay. Now, both of them have two options. One, since company A wants to borrow in floating, company A can just go and borrow at the rate of MIBOR. Company B, on the other hand, has an option. If they want to borrow on a fixed basis, they can just go and borrow at 10%. But both of them approach to a swap bank with their problem. Okay, there is a third bank called swap bank. So both these companies approach them and they tell swap bank that bank A has given this quotation and bank B have given this quotation. Now what do you suggest? So swap bank does a simple calculation. Swap bank says that okay, let me take two different permutation and combination here. The first one, I say that A borrows in fixed and B borrows in floating, which is in opposite to what their preferences are. So here 7% plus MIBOR plus 1%. So their overall cost of borrowing will become MIBOR plus 8%. And the bank says that okay, let me also see what is the second option. Second option is floating of A and fixed of B, which is as good as their individual preferences, their stated preferences. And here it will be MIBOR plus 10%. So here it is MIBOR plus 10%. So in option 1, they were having MIBOR plus 8%. Here they are having MIBOR plus 10%. So that means option 1 is cheaper. Option 1 is actual borrowing in opposite to what their preferences borrowing are. So this 2% there is a saving. Now see how this swap bank actually constructs a product. So swap bank instructs to company A that you go and borrow in fixed with your bank A, and you end up paying 7% of that loan amount to bank A. Swap bank also tells company B to borrow in MIBOR plus 1%, which is in floating from bank B, and keep on paying this interest rate to bank B. Now, company and company B tell swap bank, but what about our preferences? Company A says that I have a preference to borrow in floating. So, swap bank says that okay, you do a swap with me, wherein you pay me MIBOR. We will come to how they have arrived at the calculation, students. Okay, but just stick to the discussion as of now. So company A will pay swap bank equivalent to MIBOR, which is a floating rate, and swap bank has arrived at this calculation of 7.75, which swap bank says that I will pay you 7.75. You pay me MIBOR, I will pay you 7.75. This is the swap that has been agreed between swap bank and company A. And company B says that I am paying to bank B in floating. So swap bank says to and you pay me the fixed rate of 8.25 percentage. So company B will pay to swap bank 8.25, which is fixed. Swap bank will pay to company B MIBOR equivalent amount, which is the floating rate. Now, what do you see overall? What has happened here is okay, this is the fixed and floating that I was explaining. Yes. Now, after swap, what will happen? Company A will pay MIBOR to swap bank 7% to bank A minus 7.75% which will receive from swap bank. So in totality, the effective rate becomes MIBOR minus 0.75%. Clear? This is their floating rate that has effectively converted into the floating rate. Okay. Now from companies B's perspective, they will pay MIBOR plus 1% to bank B, right? The rate at which they have borrowed minus MIBOR that will be received from swap bank plus 8.25 will be paid to swap bank. That is what swap bank has agreed with bank B. Sorry, company B, wherein swap bank will pay company B MIBOR and swap bank will receive 8.25 from company B. So this 9.25, if you solve for this, MIBOR gets eliminated. So 1 plus 8.25 becomes 9.25. So 9.25 becomes fixed. So this gets converted into fixed obligations. Correct? So you see, originally they have borrowed into their opposite preferences, but ultimately, because of the swap, they are now able to borrow in their stated preferences. Okay. So if you see what is the total collective payout, students, MIBOR minus 0.75% is with the company A, plus 9.25% is with the company B. So the interest payout, it happens as MIBOR plus 8.5%. That's the interest payout, minus received by bank A and bank B is how much? So they are receiving how much? They are receiving in totality as per option 1. Option 1 was MIBOR plus 8%, correct? So in totality, they are getting MIBOR plus 8. The company and company B are paying MIBOR plus 8.5. That means zero point 0.5 extra they are paying, which is going into swap bank as commission. So because swap bank will also not do charity, right? Swap bank will also expect some commission. So zero point 0.5 is going to swap bank. So this is how the numbers have been worked out by swap bank. Now see, option 2 was MIBOR plus 10%. Option 1 was MIBOR plus 8%, which is a cheaper option. So 2% there is a saving, students. Now if this 2% is a saving, this 2% has to be bifurcated between company A, company B, and swap bank. So swap bank is getting 0.5%, students, right? Let's say the swap bank is saying that I will get 0.5 percentage commission, and company A and company B. So out of this 2% is 0.5 is given to swap bank, 1.5. So 1.5 will get distributed into 0.75 between company A and company B. And hence, if you see both of them, company A would have borrowed at MIBOR, but they are able to reduce it to MIBOR minus 0.75. So basically, this is how the computation has been done. So 0.75 company A has gained, and 0.75 company B has also gained, students. Okay, so if you see, this is the pre and post swap situations. Company A, if there is no swap, then there is MIBOR. If there is a swap, then there is MIBOR minus 0.75. There is a saving of 0.75. Company B, no swap, they would have entered into 10%. Now they are incurring 9.25. So 0.75 becomes their net amount. Similarly, for swap bank, nil, 0.5 is their earning. So in totality, they are ending up at 2%, students. So this is what their overall savings is, students. Okay, perfect. So Lavanya is asking one question. Is it always true that our preferred interest option will be paid to swap bank? I would say it will depend on the market situations and your quote with the bank. Right now, for example, in this situation itself, Lavanya, just to clarify, had both of these companies been very established companies, both company A and company B had been very established companies, so the quote that the bank would have given to respective companies would have been very similar, and hence there would have not been any higher value in deriving the swap. Okay, so one, it will depend on the characteristic or on the, let's say, financial hygiene of both company and company B, and hence what they're getting in terms of their respective quotations. Okay, clear?
So will you explain the calculations?
Sorry,
Will you explain the calculations?
which calculation? Sorry, so you were talking about this 7.75, this one, 7.75 and 8.25. This is what you're talking about.
Yes, Mala, these will be given now.
Okay, I'll tell you. See, from the quotient perspective. Okay, first of all, from a concept perspective, is it clear or not?
Yes, sir.
Conceptually, it is clear. Yes. Now, from a quotient perspective, there will be limited question that will come, in which, let's say, even if we have to calculate this here, 7.75. Okay. Now, in my example, I have just simply said that this 1.5 will get distributed into 0.75 and 0.75, right? So we can back calculate for achieving this 0.75 gain to company A, what should be my this fixed percentage, right? So in this case, it is 7.75 that we can do. However, in the questions, these values will be given to you. That what is the swap that we are talking about? Or if let's say this value is not given to you and they're asking you to calculate, they will tell you that how much gain is attributed to company A. Okay,
Yes, sir.
clear? Wait, I think there is a specific request from Lavanya on the question side. Can we do a question here? Okay, so see, this is the question. Question number 7 that we would have discussed on the swap. So if you see, this is a relatively very simple question. This is a swap of foreign currency. Okay, but the concept and everything remains same. So A Inc. and B Inc. intend to borrow $2 lakh and $2 lakh in yen respectively for a time horizon of 1 year. So 2 lakh dollar and 2 lakh dollar in yen. Now see their stated preferences is what? A Inc. wants to borrow in dollars, B Inc. wants to borrow in yen. Okay, but their notional amount that they want to borrow is same. The prevalent interest rate are as follows. So they have given you a matrix here, right? So A Inc. and B Inc. if they borrow in yen, what is the interest rate? If they borrow in dollars, what is the interest rate? Perfectly fine. The prevalent exchange rate is $1 is equal to 120 yen. They enter into a currency swap under which it is agreed that B Inc. will pay A Inc. at the rate of 1% over the yen loan interest rate, which the later will have to pay as a result of the agreed currency swap. So you see here, they have they have given you an indication that 1% plus the B Inc. would have taken a yen loan interest rate on that the amount will get calculated for the overall swap. Okay, whereas A Inc. will reimburse to B Inc. only to the extent of 9%. So you see here, the 9% is agreed as a swap. So they have given you the way to calculate how to achieve at this link. Keeping the exchange rate invariant, quantify the opportunity gain or loss of the ultimate outcome resulting from the designed currency swap. Now, if you see, let me just summarize here. Their preferred borrowing is what? A into dollars and B into yen. But the swap is what? That the B Inc. will be paying to A Inc. 1% plus 5%, which is the A Inc. getting borrowed in yen, right? So this is 1 plus 5 is equal to 6% is what they have agreed as a swap. And A Inc. has will pay to B Inc. at the fixed rate of 9%. Clear? Now, if you see, this is what the question is. Now, if you see, we devise the different options. Option 1, A Inc. and B Inc. borrow as per their stated preferences. So, what is their rate? 17%, right? 9 here and 8 here. Similarly, if A and B borrows as opposed to their preferences, the similar logic that we have applied in our discussion, here what will happen? A will borrow at yen and B will borrow at dollar. So in totality, they will end up borrowing at 15%. So these are the above two options. So which option will you choose, students? 17 or 15? Come on, tell me, option 1 or option 2? Yes, 15, option 2. So the moment you choose option 2, then you will have to design a swap because this is not their stated preference. This is opposite, right? So you'll have to design a swap. Now, while designing a swap, the question has already told you that B will pay to A 6% and A will pay to B 9%. Clear? So, what we will do? The following will be the swap payments. A will pay to B 9% and B will pay to A 6%. Correct? So, now see students, this is the swap. So, A will borrow in yen, B will borrow in dollar, which is opposite to their preferences, A will end up paying 5% here, B will end up paying 10% here, which is with their respective banks. Now, A will pay to swap bank 9% and receive 6% from B Inc. Similarly, B Inc. will receive from swap bank, which is coming from A 9% and here as 6%. Now, if you see, is there any commission involved with the swap bank? The answer is no. So the question has not told you that is there any commission to swap bank. So we will ignore it and then we will continue accordingly. So if you see now, what is the overall rate of interest to cost A Inc? 5%, which is as per the original loan, 9% to B Inc. that will be paid, and 6% will be received. So in a nutshell, 8% is the net interest expense for A Inc. And for B Inc. it will be 10% to the bank that B is giving, 6% will be paid to A Inc. and 9% is received from A Inc. So in a nutshell, 7% is their overall interest cost. Clear? So this 8 plus 7 is also 15. So this is their effective cost of borrowing, 8 and 7. Clear, students? Then we would have calculated what is the gain or loss here. Any query till now, students, apart from this? Okay, perfect. So interest rate risk management, students, let me just quickly check the query handle as well in case there is some other question. No. I hope the discussion is clear. Do let me know in case of any queries. So if I just sum up, so interest rate risk management, students, talks about the ways of mitigating the interest rate risk. And this happens through this five methods, right? One, asset and liability method. Second, forward rate agreement. Third, interest rate futures, interest rate guarantees, and interest rate swaps. So in all these, the idea is to enter into a commitment of a known interest rates of future. Somewhere you are entering into a commitment, somewhere your interest rate swap is available to you as an option wherein you can enter into those products and deal with your interest rate risks. Okay, so this was it from the discussion from the revisionary aspect of the interest rate risk management, students. Let's take a quick break of 10 minutes, then we will start with our discussion on the mergers and acquisition, students. Okay, thank you. Let's start our discussion on the mergers and acquisitions and startup finance. So, in case of mergers and acquisition students, first of all, let's try to understand that what are the different types of mergers and acquisitions. What are the different cases in a mergers and acquisitions? So, the first one, which is a more popular one, is wherein there is an entity called A and there is an entity called B. So, the B entity merges itself into A entity. In just a second, and the B's independent identity is dissolved. Okay, so the B, all the assets and liabilities of B gets merged into the assets and liabilities of A, and the B's separate legal entity is dissolved. And post merger, A will carry the business of A plus B put together. Clear? So that is one form of merger. Second, wherein A acquires a majority stake in B Limited. Okay, it's again a form of acquisition, right? Because let's say if you're acquiring a company, more than 50% shares if you acquire, so the relationship becomes the holding and the subsidiary company. Okay, and their legal entity identity remains as is even post acquisition. The third case, students, is wherein A is having two different businesses, business one and business two. Business one is of textile business and business two is of perfume business. So what they do, they transfer business to, okay, from A limited to B limited. Only one part of the business is transferred. So what is happening here? There is a demerger. So the existing company's two businesses are demerged and they are taken up into separate companies now. Okay, from the mergers and acquisitions perspective. Fourth case, there are two different companies which both of them are dissolved and they enter into a new company called C. So the business, both their businesses gets merged, and after merging they evolve as a new company called C, which takes on their collective businesses, but A and B put together are dissolved. This is also one form of M&A. Then the next case is there is a company called A which is into perfumes, and there is a company called B in which there are two businesses, deodorants and soap. Okay, so what happens here is that A and B both continue their legal identity, but A will purchase the deodorants business, which is related to, let's say, their perfumes business from B, and A will pay the purchase consideration to B. Now, what is meant by purchase consideration, students? Purchase consideration is the amount that is paid for acquiring a company, for acquiring a business, for the other company being merged into the main company. Okay, so both of them will continue with their separate legal identity. Yes, Saminathan, you're right. Amount paid to B for consideration is purchase consideration. Now, if you see, students, in some of the cases, the entire company is getting transferred. In some of the cases, only some segment of the company is getting transferred. Some specific section of the business is getting transferred. Right? Now, in these cases, there is a specific agreement made called as business transfer agreement, which is called as BTA. So this BTA will define the terms and conditions, the rights and obligations of both A Limited and B Limited, even their shareholders for that matter. Okay. Then comes A Limited, which is an acquiring company, B Limited, which is a target company. Okay. Herein B is merging with A. There is a share. So the shareholders of B Limited will get the consideration, right? They are the ones who are supposed to be compensated. Now, if we talk about the purchase considerations, okay, it can take different forms. but we are restricting our discussion to these three forms, which are even most commonly used. So first one is the equity shares of A Limited is issued to the shareholders of B Limited. Now in all our cases, A Limited is the buying entity and B Limited is the selling entity. Okay, in all our discussions. So A Limited is going to compensate B Limited's shareholders. So equity shares of A Limited will be issued to the shareholders of B Limited, students. Okay, and they will come up that what is the right swap ratio. Okay, what is the right swap ratio? So swap ratio means that for how many shares of B Limited, how many shares of A Limited will be issued. So that is their swap ratio. Okay. Then the second piece is the cash payment, wherein the outflow of the funds will also be checked, wherein the shareholders of B Limited will receive the actual cash payment in the form of the value of payment. Then the third one will be combination of 1 and 2, which is the value plus swap ratio put together. Okay. Now, in all these cases, there we have to actually see what is the business valuation principle, students, because business valuation principles will be applied in arriving at what is the right swap ratio, what is the right value of payment, and what is the right valuation when it comes to a combination of both. Clear? Now, if you see in the entire mergers and acquisitions, we will be discussing about what all aspects. One, how do we compute A Limited's equity value, which is the buying company? How do we compute B Limited's equity value, which is the selling company? How do we then compute their swap ratio? Because swap ratio will tell you how many shares of A Limited will be given for how many shares of B Limited. For that, it is very much important to compute the independent equity value of A Limited and independent equity value of B Limited. At the same time, students, I would want to tell you that there are different ways to calculate a swap ratio. There is not a single way. The overarching principle we will definitely tell you with some of the examples. But if question specifies anything specific, so we will have to go for calculating the swap ratio basis that. Okay. So we'll come to the detailed discussion of swap ratio. Then the last part that the topic, or let's say the conceptual understanding that we need to build is about the post merger analysis. So let's say you kind of decided before merger that these are the things that you want to achieve. So post merger, whether you have achieved those things or not will be the question that will be taken into consideration. Okay. So now let's come. The first one, okay, let the first understanding is on the price earnings ratio. Price earnings ratio, we all know, students, price divided by earnings, or market price per share divided by the earnings per share. Okay, this is called as the PE ratio. Now, in terms of the swap ratio, okay, swap ratio will be calculated based on different matrices as we discussed. So the first one can be market price based, wherein we will take the market price of B Limited divided by the market price of A Limited. Now, please do remember, students, here B Limited is the selling entity. For the sake of simplicity, I am referring to them as selling entity. A Limited is the buying entity. Okay, please do remember this. So MPS of B Limited divided by the MPS of A Limited. Similarly, earnings based model will be earnings per share of B Limited divided by the earnings per share of A Limited. Okay, clear? Then book value per share of B Limited divided by the book value per share of A Limited. This is for the book value per share. Then gross NPA of A Limited divided by the gross NPA of B Limited. Now here there is a swap. Now, if you see till now, whatever are the good matrices, for example, market per share, earnings per share, book value per share. So for all of them, the values were put in such a way that what is for B limited divided by A limited, correct? However, NPA is non-performing asset. Some of you might know NPA is the non-performing asset which is reported for a bank. Now, NPA is not a good ratio to have. So, if you divide NPA of A limited into denominator and NPA of B limited into numerator, so then what will happen? The higher NPA will mean higher swap ratio, which is not the right thing. So hence we will have to take a reversal of this, wherein we are saying NPA of gross will be A limited in the numerator divided by the gross NPA of B limited into the denominator. Okay. Earnings per share, students, is actually earnings attributable to equity shareholders divided by the number of equity shares. This is what we have already discussed, right? So in a nutshell, students, these ratios are generally computed as the per share value in numerator divided by the per share value in denominator. Simple. Gross NPA is there in one of the questions, I think the last question on the bank, right? In that the gross NPA is being used, wherein we can just use the gross NPA of A limited divided by the gross NPA of B limited. Clear? Now let's talk about the EPS post merger, or what are the after merger things that we are going to discuss. One, in case of share settlement. Now, see, students, the treatment, or let's say the post merger analysis, will be different. If you talk about share settlement, it will be different if you talk about the cash settlement, right? If you talk about the share settlement, then so the EPS post merger means earnings per share post merger will be what? It will be PAT of A, PAT of B plus synergy gain divided by equity shares of A limited plus equity shares issued to the shareholders of B limited. Clear? So profit after tax of A limited, profit after tax of B limited. That's their merged entities profits plus synergy gain. Now, what is meant by synergy gain? Synergy gain is something over and above their individual profits. For example, both company A and company B before their merger were having general management, were having administrative cost, were having board of different board of directors. Now, after they have merged, some of these costs will go away, right? Some of these costs will go away. That will help in a gain, sorry, which will come over and above. That is one. Second, let's say company A and company B were operating as, let's say, uh, so company A was a supplier and company B was was a customer. Now synergy gain will mean what? I mean whatever let's say orders now B will give to A, that will become captive, that will become inside. It will lead to economies of scale. It will lead to higher, you know, internal production to happen, and hence the higher efficiencies which will lead to synergy gains, which would have not happened because of both of them being operated individually. Now because both of them are doing collective business, and hence it will lead to synergy. Yes, Aminathan, you are correct. Synergy gain is inorganic growth after the merger. Yes, because organic growth is what? Which you are bringing the growth on your base, right? On a similar level of base. Inorganic growth is something that you are moving beyond. Okay. Divided by the equity shares of A limited that was pre merger plus equity shares issued to the shareholders of B limited that is post merger, right? These are the shares that are issued to the shareholders of B limited that is post merger, the incremental shares that will help you to derive the earnings per share post merger. Second, through payment of funds. So the earnings per share, in case we are paying through funds, can be calculated as PAT of A plus PAT of B plus synergy gain. So this remains same, and this divided by the equity shares of A limited. Now since we have paid through funds, right? So what we will do minus whatever cash we have paid multiplied by the return. So this is the opportunity cost. And since we are talking about PAT, which is post tax, so we will also take here 1 minus T, which is the tax rate. So that it also becomes the post tax. So the opportunity cost becomes this much divided by the equity shares of A Limited. Okay. Clear? So this is through payment of funds, we can calculate the EPS. Clear? So in this, the only thing is instead of the denominator, in the numerator itself, we are having cash paid into return, which is the opportunity cost into 1 minus T, right? That is getting reduced. Now let's come to synergy, students. Synergy is what we have individually spoken about. So this is value of A plus B, which is the merged entity, is higher than value of A and B if we add them independently. Reason being because there are some inefficiencies, there are some common costs which will get eliminated. There can be some future potential benefits in terms of the growth, right? There can be some increasing market power. For example, earlier 40% of the holding of the market, I mean the market share was with A and another 40% was with B. Now collectively they hold 80% of the market share. Yes. So in this case, what will happen? Now they will control the major supply of the market and hence they can enjoy pricing benefits, right? They can decide what prices to keep, what prices not to keep. So if they want to take a higher pricing, maybe they can take it. So all of these things will get count under the synergy gain. Yes, Prashant, you're right. So the whole is greater than sum of parts. That's what we call as synergy. Okay. Now, effect on EPS post merger. Now, sometimes the question might ask you to calculate the effect on EPS post merger, students. Okay, till now we have calculated the EPS post merger. Now, the effect on EPS post merger will be calculated how? Now, please do remember, students, effect is not that simple to calculate, right? It involves some level of caution here. If you talk about from A Limited perspective, okay, A Limited is the one who is acquiring, right? Now, the one share pre-merger of A Limited is equal to one share of post-merger A Limited. Can I say the statement is correct? I'm repeating the statement. One share of A Limited pre-merger is equal to one share of post-merger A Limited. Is this statement correct?
No, sir.
Samanathan, you're right. Okay, so Lavanya, Samanathan, you have responded. It is yes. I can hear there was a no in between. Can we share the reason why it is no? Why do we think so it is no?
So won't the value of A change?
No, 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 no. I'm not talking about the value here. I'm talking about the denomination. So the value will definitely change. I agree. But I'm just talking about whether one share pre-merger in terms of the denomination. Okay, let me say, if I am a shareholder, I am holding 1 lakh shares of A Limited pre-merger. Will I continue to hold 1 lakh shares post-merger also? The answer is yes, because I am a limited shareholder, right? For me, the life is not changing. Only thing is my price can change. That I agree, yes. But that is the second part of the discussion. So what we can do if I want to compare impact on my shares EPS, then I can just compare my pre-merger EPS and post-merger EPS, and I can compute the impact, which is straightforward, right? What is my post-merger EPS and what is my pre-merger EPS? 1 is to 1, ratio remains same, and I can calculate the impact. Post-merger EPS from where you will get? You will get it from here, the ones that we have discussed here, right? In case of share settlement, this is the formula. In case of payment through funds, this is the formula. Clear? Then let's talk about B Limited's perspective. Now I am asking the same question again. From B Limited's perspective, if I'm holding one share of B Limited pre-merger, Will I continue to hold same one share in A Limited post merger? Please remember now B Limited is not there, right? Yes, Geeta, you're right. Samanathan, you're also right. Yes, Lavanya, you're also right. So here there is an involvement of swap ratio, students, right? Because one share pre-merger, one share pre-merger of B Limited is not equal to one share post-merger of A Limited. Correct? See, first of all, students, B Limited after merger will not have its identity, or even if it has, the effect of merger on equity shares is not getting computed on B Limited's holding. Okay, it's always getting calculated post merger A Limited's holding. That is point number one. Point number two, we cannot take this inherent assumption of 1:1. Then what we have to do? We know what is the pre-merger EPS of B Limited, and we know what is the post-merger EPS of A Limited. We just have to find a common equation. Yes, Saminathan, you're right. Based on the swap ratio, it will vary. So what are we going to do here? We are just going to take post-merger EPS of A Limited adjusted for swap ratio here, students. So here we will adjust it for swap ratio less pre-merger EPS of B Limited, and hence this is the net impact on target company's EPS. Okay, so this has to be adjusted for swap ratio. Then we will reduce the pre-merger EPS to arrive at the net impact on target company's EPS. Clear? So one share of A Limited is not equal to the one share of B Limited pre-merger. This we have already discussed, students. Now, sometimes the question, okay, let me say here only, in case of EPS, instead of EPS, sometimes the question might ask you to calculate the effect on MPS post merger, market price per share post merger. Then the everything remains same. The effect on market price per share post merger will be post merger MPS here less pre merger MPS for A Limited. 1:1 equation is sorted. From B Limited's perspective, the MPS post merger of A Limited adjusted for swap ratio minus pre merger MPS of B Limited. Simple. Everything remains same. Instead of EPS everywhere, MPS comes. But the question which I'm trying to the concern which I'm trying to solve for here is, even in case of MPS, the swap ratio will be adjusted if you are trying to calculate from B Limited's perspective, students. Now let's come to value of acquisition. Value of acquisition is always calculated from A Limited's perspective, which is the acquiring company, right? So if I say you that what is the value of acquisition? So the value of acquisition is whatever is the value of merged entity, which is A plus B put together, minus value of acquiring company before merger. So that means this is the net value addition that has happened. For example, the market cap was 100 crore of A Limited. After acquiring, the market cap have become 120 crore. So 20 crore is the value of acquisition that will be considered from the A Limited's perspective. Now, the question might ask you that calculate the gain or loss to shareholders. Post this merger, calculate the gain or loss to shareholders. So here, for A Limited, the MPS of post-merger A Limited will be taken. From that, the MPS of pre-merger A Limited will be reduced. So this is again 1:1. Okay. Now from B Limited's perspective, MPS of post-merger A Limited will be taken, which is adjusted for swap ratio minus MPS of pre-merger B Limited will be taken, which is again a gain or loss. Clear? So here also we are adjusting for the swap ratio. So this is for A Limited and B Limited. Again, the same logic applies for market share, market price per share. That is where we are using for gain or loss. Okay. Then, students, we all know what is meant by market capitalization. Market capitalization is the market price per share into number of equity shares, right? That we call as market capitalization. Promoter holding, we call it as 60% or X%, whatever it may be. So the free float market cap becomes market cap into 1 minus X percentage. Okay, so this becomes 1 minus X percentage. The true cost of merger is actually the gain to shareholders of B Limited. Okay, the true cost of merger is basically gain to shareholders of B Limited, which is a target company. And this gain to shareholders of B Limited is coming from where? The gain or loss that we have computed above. Yes, Aminathan, you're right. Then the value of merger is actually the gain to the shareholders of A Limited, which is from the acquiring company's perspective. Okay. I think then these are some of the questions which are based on the pointers that we have just now discussed. Yes. So sometimes, I mean, now you see some of the questions are so much interrelated to the previous topics. Now, the MPS would have not been given, or let's say the cost of equity would have not been given. To compute that, we are using the dividend growth model formula, right? So, I mean, it might, when you study mergers and acquisition, it is not only this, it is about the valuation principles, it is about the previous formulas also that we have discussed. So, keep all the things in mind, okay? I'm just going through in case something is specific here that we can discuss. We may want to discuss. Otherwise, in case of any queries also, students, please do let me know. Please do put it. We will cover up the queries. Now, if you see somewhere the question might ask you that what is the maximum ratio acceptable to the shareholders of, let's say, either A Limited or B Limited. The answer remains same. You have to compute the swap ratio and accordingly you need to let the examiner know that what is the maximum ratio, right? Because conceptually, basis the swap ratio, which is adjusted for their preferences, will become their overall maximum ratio, students.
Sir, ratio or will they ask the maximum amount? They sometimes ask maximum amount.
In case they ask the maximum amount, so basis the ratio, we can compute the number of equity shares and hence we can quote them the amount. And we will have to just multiply with the market price per share as well, okay? Yes. So this is one specific question, students, on demerger, okay? Wherein there is a company called Fortune India Limited. This is a total company. This is getting split into Fortune Pharma and FMCG business separately, right? So what is happening here? So this entire have two businesses, FMCG and pharma. So pharma, they are demerging it out. Okay. So this is a question on that basically. Now what will happen? How do you really value the pharma business? How do you value basis the net assets model, basis the future earnings model? So this is what the question is all about. Okay. But don't get confused here. The everything, the conceptually everything, it remains same. Now this is a question on the banks, right, that we were discussing. If you see the NPA percentage is used here that we were talking about in previously, right? So if you see 40 is the weak bank's NPA percentage, which is the target bank. 5 is the acquiring bank's NPA percentage, which is the bank which is acquiring. Okay. So this is, I think, all about on the questions. Now let us go to some of the other discussion points on mergers and acquisitions. So yes, starting with rationale for mergers and acquisition. Now, some of the times it might be asked that why there is a need for mergers or acquisition. So the answer remains same. I mean, there are certain specific pointers to it. One, synergy, which we've already discussed, that synergy is basically your combined entity's value will be higher than the individual entity's value. And you see more value while you want to merge and continue your business rather than doing your business separately, right? Second is actually diversification. So, students, in your portfolio management, you would have studied that the unsystematic risk can be diversified, right? There are two types of risk, right? Systematic risk and unsystematic risk. Systematic risk is because of the macro factors. Unsystematic risk is because of the industry or the company specific factors. So that unsystematic risk can be diversified. How? Let's say A and B are, A is into the FMCG business, B is into the real estate business, both of them unrelated. Both of them, if we invest, there is a diversification because you are trying to diversify into different unrelated industries. Okay, so that is also one of the reason for merger and acquisition diversification. Third, taxation, very very important. Yes, Saminathan, you're right. Unsystematic risk is a micro risk within the company which can be reduced, which can be diversified. Systematic risk is available at a market level, at a country level, which cannot be diversified. Okay. Now coming to taxation. So taxation is a very, very important piece because as per Indian laws, you are allowed to set off the accumulated losses and the unabsorbed depreciation, right, up to a certain period, and that will help you to adjust for any future taxable liabilities that might arise. So assume a weak company is there which has accumulated losses which is carrying forward for the tax purposes. The same can be acquired by a strong company, okay, which can be adjusted against the profitability of the strong company. But again, it might depend on the exact law position, that on the other facts and cases. But taxation often is also one of the I would say one of the rationale for a merger or acquisition. Okay, because as per this, they might want to take the benefit of the taxes. The strong company might want to take the benefit of the taxes from weak company. Okay, then let's come to the growth. Now, students, if you see, somebody have also spoken about the organic or inorganic growth, right? Now, what is meant by organic growth? Organic growth is the growth which is coming from the same set of resources or the same set of audiences. Okay. Inorganic growth means wherein you are getting the growth from the new, let's say, company in terms of the acquisition. For example, A Limited, if you talk about year one, there was 1,000 crore turnover or profit, whatever you want to say. In the next year, it became 1,100. So there is a 10% growth, which is a organic growth. But there is a company called B Limited, which is also having 600 crore of turnover. So once you acquire that, your overall turnover becomes 1,700 crore from 1,000 crore. That means out of that 600 crore has come inorganically and 100 crore has come organically. Clear? So there is an inorganic growth of 600 crore and there is an organic growth of 100 crore. Okay. Now, growth is also one of the important parameter for mergers and acquisition because you want your businesses to grow. You want your P&Ls to grow. Because of that, you look for possible opportunities to acquire. Then, consolidation of production capacities and increasing market power. This means what essentially? This means that there are two things. One is production capacities. For example, there is a specific industry in which there are only handful of companies which are having the capacities installed for production. Now, if two of them, the major players, decides to combine, let's say 60% and 10%, they were having the production capacities. Now, collectively, they will control the 70% of the industry in terms of the production capacity. Similarly, market power. Let's say A Limited has a market share of 40% and B Limited also have 40%. Collectively, now they hold 80%. So this is also one of the overall increasing market power example, wherein now they collectively own the market at 80%, wherein now they can decide about the pricing, they can decide about the profitability, they can decide about the other things.
Benefits of monopolizing.
That is true, benefits of monopolizing. At the same time, I would also like to mention a fact about the Competition Commission of India. Okay, if let's say there is a takeover or a merger or acquisition that happens with the specific intention of this, then Competition Commission of India also comes into play. Okay, this is something separate I'm talking about. So in practical life, there are many factors that you want to think about when these, let's say a consolidation of a market power is happening specifically, because then what might happen, consumer might be at a disadvantageous footing. Okay, then let's also discuss about the different types and forms of mergers and acquisitions. What are the different types and forms of M&A? The first one is horizontal merger. Horizontal, as the name suggests, it's horizontally merged. What do we mean by horizontal? There is an industry is a collection of similar set of companies, right, which are catering to the similar consumers, which are producing the similar products, right? So within one industry, if two different companies merge with each other, that is called as horizontal merger, because they are merging horizontally, because they are at the same level, right? Not financially, not, let's say, profitability wise, but from a working perspective, from a, let's say, consumer perspective. Vertical merger, another important and practical one. Here what happens, there is a company, let's say A Limited, there is a supplier of A Limited called B Limited, and there is a customer of A Limited which is called as C Limited. So if let's say both B Limited and A Limited decides to merge, wherein A Limited was the customer and B Limited was the vendor. So B Limited is acquired by A Limited, or B Limited merged into A Limited. That is called as backward integration. This is part of the vertical merger. Why vertical? Because they are part of the vertical value chain. This is the vertical value chain, right? Supplier is giving to A, is then giving to C. Then, if let's say C gets merged into A Limited, let's say a customer is acquired by A Limited, that is called as forward integration. Herein, we are acquiring the customers as well. Now, why it is relevant? The vertical merger is a merger which is a very powerful merger. It will help you to kind of take the benefit of your buyer and seller relationship, and again to work on the economies of scale. Yes, there is a horizontal integration that happens. That is here, horizontal merger. Okay. Then conglomerate merger, students. Now, what do you mean by conglomerate? We say conglomerate, we say A Limited is a conglomerate, which is into different nature of businesses, which are totally unrelated. A Limited and B Limited, these are all unrelated and these are into the different nature of businesses. That is called as conglomerate. Okay. If they merge into each other, that is called as conglomerate merger. For example, FMCG and real estate. This is, let's say, FMCG and this is real estate. If both of them merge, that is called as conglomerate merger because their nature of business is unrelated. Yes, different industry merged together is called as conglomerate. Then comes co-generic merger. So co-generic merger, students, something is common. We say that, okay, what is the overall genre of this company? Either they are from same industry or there are some common factors which are common. For example, technology. They have a common distribution channel, okay, and their product line is similar. So, so what we are trying to say that there is some commonality between both A limited and B limited. But this is not a horizontal, this is not a vertical, this is not a conglomerate. This is a separate merger called co-generic merger. Now let's understand this with the help of example. Let's say there are two NBFCs. One is in the auto loans. Auto loans mean automobile loans, and second one is into the credit card. Okay. Now, if you see their customers are different, right? Because the customers are having specific needs. One is for the personal form of financing. Second one is the automobile financing. But they are part of the same industry, which is giving loans. Do they have a distribution channel? Yes, they are getting the loans through agents. What is their product line? Again, giving loan. So this type of merger is called as co-generic merger because their genre is same. That's why it is called as co-generic merger. I hope this is clear, students. Perfect. Then comes the reverse merger, students. So till now in merger, or let's say naturally, we understand that the large company actually gets buys a smaller company, right? So that is what the general nature of the merger is. So herein, what happens? A private company takes over a public company. A private company takes over a public company. A public company is already listed. It has already given its IPO. It has already done its IPO. It's listed, but this public company is into, let's say, losses. It's a company which is not able to operate. So what will private company will do? It will take over and it will now kind of operate together, and private company had an intention to go listed. Now there is no need because through this public company they will continue to be a listed company. Clear? Then acquisition is simply something which is purchasing a majority stake or where you control the board of directors, because control is also a very important part wherein using which you can go to the acquisition. Now, divestiture, students. Divestiture is basically where you sell the assets or group of assets. There are four different types of divestiture. One, sell off or partial sell off. This is called as slump sale of business, wherein you just sell some part of your business. I mean, the entire business, but this is one part of your business amongst the multiple business. Spin off. In spin off, you do what? There are two different businesses. One business, you create a new company which is called as spin-off, and the new company is still with the old company, right? Within the same management of the old company. So you are selling here to the third party. Here you are selling it to the company which is part of the same management. Split up. Now A is dissolved and different companies gets created. That is called as split up. Equity carve out. Equity carve out is spin off plus issue of new equity shares in the market. So this one, you are doing a spin off and then you are issuing new shares to the market. And then there is a demerger, division of the family owned businesses, where you just divide the businesses into different, let's say, preferences of the family members, or you demerge and sell it to a third party. Then there is a specific called financial restructuring, students. So I think this is one of the topic that you have already studied earlier. What we mean by this? We mean that there is a sick company which has accumulated losses. There is a huge debt. There is a cash flow crisis. There is negative net worth, right? These are the things that are there. How can we revive it? It can be revived through, let's say, shareholders. We tell them that you had a 10 rupees paid up share capital. Now it is reduced to 5 rupees, right? So balance 5 rupees we have utilized to write off the losses, for example. Second, from loans and borrowing standpoint, we tell them instead of 10%, now we will only pay you 7%. Okay, lower rate of interest. Third, convertible into equity. So the debts gets converted into equity, and hence the convertibility portion is also there. So that we avoid the actual cash outflow. And then we also ask for the working capital credit from the vendor. Okay, so that there is a collection happening on time from the customers. Then comes ownership restructuring, students. Ownership restructuring means there are changes to the way the ownership is held. The first one is going private. This is something that you would have seen rarely, wherein we buy back shares from the market to become private. Let's say you are a listed company, you buy back shares, becomes private. Management buyout means that the management of the company itself buys out from the owners. So management takes over the ownership. Leveraged buyout means that you take a borrowing and then you do a purchase consideration. Then you pay a purchase consideration. So basically, for the payment, you take loan from backend. That is called as leveraged buyout because you are leveraging your borrowing to buyout. And equity buyback is a simple one, whereas a normal buyback of equity. Okay. Yeah, this is something important that I want to discuss. And new. Okay. So this is a specific concept on special purpose acquisition company. Now, what is this? Special purpose acquisition company is a company which comes with an IPO. It raises funds from the public, but it is not telling you about the utilization objectives of that funds. It will say that we will keep that amount into a trust or an escrow account for 2 to 3 years. After 2 to 3 years, we will look for a target company which can be acquired, and we will again float that proposal within the shareholders for their approval, and the deal will be finalized, and then we will be investing into that specific target company. These are called as blank check companies. Why? Because the amount that they are getting from the investors is not for a specific purpose as of now. The color of that investment is not specified as of now. Correct? So they will be coming up with some, let's say, a proposal, and then accordingly they will be investing later on. But this is called as special purpose acquisition company, students. Okay. So this was it on mergers and acquisitions. Let's quickly come to startup finance, students. Okay. So startup finance we will cover briefly. It's not that very big thing. So startup finance, students, first of all, we need to understand what is called as a startup. Okay. Startup has a, so basis a notification from the government of India. The definition of startup is given. One, it's a it should be a private company or a registered partnership firm or a limited liability. So they have told you that the legal form of a startup should be a company or a registered partnership firm. Even LLP is also allowed. So second is it should be in the first 10 years of incorporation. The moment you enter into your 11th year of incorporation, you are not a startup anymore. Third, turnover should be up to 100 crore. If you achieve more than 100 crore, that means you have crossed the basically a smaller company definition, and now you are a established company. Okay, so the turnover should be up to 100 crore. Then it should not be formed through a split or reconstruction of the existing business. Let's say you have a 500 crore company, turnover company. What you do, you split into five companies and 100 crore each. That is not allowed. Fifth one is innovation, develop or improve. product, process, or service. So it talks about that there has to be some specific intervention of how you innovate, you develop or improve what, either your product or your process or your services, which should be help, which should be scalable, help in wealth generation and employment opportunities. So these are the overall objectives with which, if you do a business, then only it will be regarded as a startup. Now, in these businesses, students, there is a basic problem. How do you finance the startups, right? Because these are the smaller businesses, they face a lot of issues in terms of the financing. So what are the innovative ways to finance a startup? The first one is personal financing, wherein the promoter, or let's say the founder themselves, try to fund it whichever way they are able to do personally, right? Whatever is the personal sources of funds. Let's say their savings, their investments personally. That. Second, personal credit line. Personal credit line will be the ones which are, let's say, they are personal credit cards, right? So they will be using those to make, let's say, payments. They will be using those to do the business, the specific business related activities. Then third is friends and families, right? They can reach out to the specific people in their friend and family circle to obtain the financing for their startup, right? Just on an informal level. Then peer to peer lending. Now peer to peer lending means that there is a group of co-founders, they can connect with themselves and they can take funding from each other whenever they need, right? So that is called as peer to peer lending, students. Then the next one is crowdfunding. Crowdfunding is something, a startup concept as well, in which there is one platform. Okay, there is a platform, this one. On this platform, there are small investors that are registered, right? They will be able to make a very small contribution also. And the startups are also listed on the second hand. They will be able to source the money on this platform. Now the individuals can decide which startup they want to basically invest and work, and accordingly they can invest in those specific startups. Okay, so this is called as crowdfunding. Crowdfunding means because you are getting investments from the crowd at large at smaller denominations, right? There is no big investor who is investing, the crowd is investing into your startups. Then microloans. Microloans are specific segment given by a lot of banks wherein they will give you a smaller loans at a cheaper rate of interest. Then there is vendor financing, students. Let's say vendor financing means asking for a extended pay terms from a vendor. If it is, let's say, 30 days, asking vendor to extend it to, let's say, 45 days, 60 days, so that you enjoy a higher credit period. Then comes purchase order financing. So purchase order financing is the one where the customer is actually financing. After you receive the PO from a customer, you ask for funds from the customer to kind of take an advance and start your work. Then the next part is factoring account receivables. So the account receivable that is sitting in your books will be used and it will be sold off to an agency where that agency will pay you now, and then later on it will recover from the customer, right? It is as good as, I mean, the factoring part we discussed in the securitization topic as well, right? Where some question was asked on the difference. Now it can happen on on two bases: one recourse basis and non-recourse basis. Again, the concept remains same. Non-recourse basis, risk is transferred. Now, tomorrow, if the amount is not paid, there is no leeway, there is no recourse back to the company who has sold those AR. Recourse basis is where the risk is not transferred. That means if tomorrow the payment is not realized, the person can claim back it from the company from whom the receivables were purchased. Okay. Yes. Then there is a concept of unicorn, students. Unicorn is a startup where the business valuation of that startup has reached $1 billion. Okay. Then there is something called as pitch presentation, because pitch presentation is important for the startups to raise money, right? So in that, what all things you would want to have? This is relatively easier. You would want to have, first of all, introduction. What is the introduction? About team. What is the problem statement that you are targeting? What is the solution that your startup is providing? How are you going to do marketing and sales of that? How is your projections looking like in terms of the P&L, cash flow, and balance sheet? What is the understanding around competition? What is your business model going to be? And then the overall financing and the valuation. Okay, so these are some of the basic things that comes to your mind when we talk about the pitch presentation. Now there is another topic called as modes of financing for startup, right? So the first one is bootstrapping. Bootstrapping means looking within your company, how can we increase the finance? Bootstrapping means, I mean, starting within what you have, right? So the first one is on working capital. For example, trade credit. We can ask vendors to extend trade credit. Similarly, factoring, we can sell our receivables to a third party agency on a recourse, non recourse basis to realize now. And the third one is leasing. This is very, very important. Instead of committing yourself into a huge amount of capex by buying a capital item right away, you can look out for leasing it, right? Just look out for leasing the spaces, renting of those assets, right? The second one is the angel investors, right? So these angel investors are those which acts like an angel, right? They are high net worth individuals who generate good amount of wealth and they are ready to invest, right? Then the third one is the venture capital, students. Now this is something very, very important to understand. Now there are two types of equity, students, when we talk about: one, a public equity; second, a private equity. A public equity is a equity where you raise the funds at large, invest into a business, and then you list on a stock exchange, right? That is called as public equity, wherein you approach people at large, they invest into your business, you get yourself listed on a stock exchange for their dealing. Private equity is a closely held equity which is often sourced from individuals which is privately held, right? They are not listed on a stock exchange. Their valuation, their information is not publicly available, right? So that is called as private equity. Now, how does it works? A private equity firm is there, right, which is enacted with the objective of a private equity. Then there is a SPV. They will float a SPV, which is a special purpose vehicle. So this private equity firm has an objective to invest private equity in some of the businesses. Okay. So then there is SPV. There is a special purpose vehicle. They will create a pool of funds. Okay. There is a pool of funds that will get created, in which the amount will be given to SPV. SPV will invest into such pool of funds. Okay, the overall governance of this SPV will be with the overall governance of pool of funds will be with the SPV. SPV will be there in the form of a trust or LLP. Okay, so what will happen? This pool of funds, they will also seek money from other investors, which are called as limited partners. These are, let's say, bank, financial institutions, pension funds, and high net worth individual. So in a way, they are getting funds from the limited partners who are having excess capital they want to invest in. Private equity firm will also invest some of their money into that pool of funds because they also want a return on their investment. So they will create a pool of funds, and then they will appoint a manager or advisor whose responsibility will be to assess the to evaluate different options, to assess different options in terms of the investments, and accordingly finalize and suggest to general partners who are generally the decision makers. So this is a specific term, students. General partners, limited partners. Limited partners are limited by their liability. They don't. So whatever they have invested, they are limited to that. General partners are the ones, those are appointed by private equity firms. These are generally the partners of these firms who take decisions where to invest. Okay, so accordingly they will come up with the different startups ideas in which they can invest with the objective of buying it, growing it, and selling it. Okay, so invest 1,000 today, grow with their interventions. Sorry, which is, let's say, they will expect at least 6 to 7 times growth. Sorry, in a span of 5 years. So 7,000 is the value at which they will exit. 1,000 is what they have entered, and 6,000 will be their sorry profit. Okay, and that they will distribute between the limited partners and the PE firm. This is their basically agenda for 5 to 10 years, how they want to operate, students. Okay. So venture capitalist students operates in such a way that they will they will invest their equity privately. They will not only just invest the amount and sit silently, they will do all the interventions through which they can grow the investments. Okay. Ideally 6 to 7 times in, let's say, in a span of 5 to 10 years, through decision making, through getting into the operations, through sitting on their board. Okay, so these are all the conditions of private equity, and then they will sell to realize the benefits of their investments. Okay. So what we understand, private equity, apart from investing, they will provide governance to the startup. One director will be there on the board, make decisions for startups, and ag- agree to grow the business. So they will aggressively grow the business, students. Okay. Then let's talk about the, in case of a venture capitalist, there is some concept about the domestic structure and offshore structure. So in case of a domestic structure, everything is within the domestic territory. The structure of VC, right? It can be offshore. So we are talking about now offshore structure. Okay. So offshore can be one, that is offshore, and second is unified. So the first one is offshore. In offshore, the SPV, which is actually holding the investments, is outside India. The manager is within India, and even the investment is also within India. So these two aspects are happening within domestic. The SPV is outside, so that is called as offshore because the funding is coming from offshore. Unified means SPV is outside India. The investments are coming from outside India, plus the investments from within India is kept in a pool of funds which is in India. That's the unified structure in the form of a trust, and it is also managed out of India. Okay. So what we are saying is venture capital is one form of the private equity, students. Okay, so private equity is a wider term. Venture capital is one form of private equity. Now, characteristic of venture capitalist, it is done with a long-term horizon, which is 3 to 10 years. There is lack of liquidity because there is no secondary market in which you can go and sell. It's not listed on a stock exchange. There is a higher risk, right? Because you are investing privately, you are investing in a smaller business. So that means it's a risk that the how the investment will turn around. Then there is equity participation, students. Okay. So equity participation of these venture capitalists in from the owner's perspective. Okay. Now, there are certain advantages of a venture capital into a business. Definitely, it will help us in the getting the long-term liquidity. We also get business partners, right, who are very well versed with the way how to grow a business, right, with the nitty-gritties of their specific lines. The director is also placed, right. Then these have a lot of connects and contracts, right? these have a lot of connects and contacts which can be used. Let's say they are in a need of a buyer or a customer, right? Through their connects and contacts, they can get in. If there is some sort of technical advice needed, so that also they can help in getting the closure. Okay. Additional round of funding. So they have a assurance that if the company is doing well, they can enter into additional round of funding. We will understand what is additional round of funding. Then eventually they can also help them to list as a IPO later on. Okay. And then trade sale. Now, what are the stages of a funding of a VC? Seed money. Seed money is for the idea that has been seeded, right? Seed means you are seeding, let's say, plant. So that's where you are seeding an idea. Through that money, it's a very small amount. You just want to check. Then startup. For setting up the startup, there is a first round of investment, second round, third round, fourth round. It can be multiple rounds. Okay. So wherein you will decide that at what stages you need the money and what amount will be invested. VC investment process is when there is a deal origination, right? Deal origination means that the manager and advisor has searched out for a specific deal and it's originated. Then it gets screened. Due diligence is also one of the specific part where you specify, where you actually go through the specific documents of the target company to see whether it is okay or not. Then there is deal structuring. So you will structure the deal that how much equity for how much investment. That is one. At what level or stages you will invest the different amounts, right? And then there is a post investment activity. After post investment activity, you will carry out, let's say, the discussion around how this you know the let's say after you have invested, how the expected versus actual kind of things are working out for you. And then there is a exit plan, how you are going to exit, at what price you are going to exit. Okay. Then there is another topic called succession planning of businesses. This is also one of the important points. So succession planning, students, is referred to the planning wherein certain key top positions are analyzed from the point of view that who is going to be the successor and why it is important, why there is a need for succession planning. First of all, let's try to understand that. One, because there is a risk mitigation that we need to do. If you don't plan for succession, that means tomorrow if suddenly there is something or the other, the key positions are not held by anyone, then the businesses will not be able to run in a proper manner. So there is a risk there, and to mitigate that risk, it's a better thing to plan the succession. Second, about the cause removal. So the cause removal is the one where, because of, let's say, some incidents which is not okay from the let's say companies at perspective. Companies at perspective says that okay, because of such and such reasons, if the director is found guilty, they will be removed. So cause removal means because of certain acts there is a removal. Because of that, the place becomes empty, the position becomes empty. There has to be a succession planning. Third, it helps to build a talent pipeline, because you know that okay, for this position there are these three people in the pipeline. So it will help you build that talent pipeline. Fourth, it helps you in the conflict resolution mechanism, because for a single position there might be 10 different contenders that would be in conflict. So you'll be able to clearly talk out that okay, if this position opens up, there will be these two, three people who are matching in terms of their skill set and the requirement. And it also means aligning the overall workforce that okay, this is the succession planning that we are talking about. Now, how can we do the business succession strategy? One, we have to evaluate the key leadership positions. See, we cannot do succession planning for all. We will have to see for which all positions we can do it. Second, We will have to map the competencies for our position. What is the competency requirement for those positions? Then we will also identify the competencies of current workforce students. Where are we looking today in terms of the current workforce? Then there is a bridge leader. Okay, for example, in the second step, we identified that there are certain core competencies which are required for this position. In the third step, we came to know that there is no one as of now in the current workforce who is having those desired competencies. Now, what will you do? You will ask that the respective individuals should undergo a training, should there should be upskilling of those, and hence the competencies for the above positions will be mapped. Then, lastly, what about bridge leader? So, bridge leader is the one, if let's say there is one leader who has exited, there is another leader who is going to come after 1 year. So till the time of 1 year, there will be a bridge leader who will try to discharge the responsibilities in terms of that proper leader for 1 year. Okay. Now, what are the challenges of succession planning? The challenges of succession planning is that whenever we talk about a startup, it always runs on the founder mindset, right? If let's say, because the decision making is generally concentrated to the founder, if they want to do they will do, if they don't want to do they will not do, then it might be very premature for startups because they are just establishing themselves as their businesses. And lastly is the founders are definitely the face of the startups, right? So they might not want anyone to succeed in terms of the way their positions are, right? So this was it from the startup finance students. Let's do one thing. Let's quickly do some of the MCQs on the entire topics that we discussed today. That is mergers and acquisitions as well as the interest rate risk management. So is there any question or query that is left? Please do let me know, students. We'll be happy to take it up. We will simultaneously move to this. Perfect. So question number one, students, I would request all of you to please put your answers in the chat box. Okay. Perfect. The first question. In Dash mergers, the acquirer and target companies are related through basic technologies, production processes, or markets. Horizontal, vertical, conglomerate, or co-generic. Just now we discussed. Yes, you're right, Prashant. Geeta, you're also right. Lavanya, you're also right. Saminathan, we need to check once. So the right answer, as all of you are saying, is D. It's co-generic merger, right? It's a co-generic merger. A dash is the sale of an asset, factory, division, product line, or subsidiary by one entity to another for a purchase consideration payable either in cash or in the form of securities. Come on, student. The second one. Yes, Lavanya, you're right. Geeta, you're also right. Yes, Saminathan, you're also right. So the right answer is sell off, partial sell off. An acquisition of a company or a division of another company which is financed entirely or particularly or partially 50% or more using borrowed funds is termed as, this we discussed, right? Is it a management buyout, going private, entity equity buyback, or leverage buyout? So they are saying if we purchase a company and the financing of that purchase is coming from a borrowing, then we call it as, yes, you're right, Lavanya. Saminathan, you're also right. The right answer is leveraged buyout. Okay. Because you are borrowing first and then buying out. The main objective of Dash is to raise money despite not having any operations or revenues. The money raised from the public is kept in an escrow account, which can be accessed while making an acquisition. Just now we discussed it, students. What is this company called as? Yes, very good. Special Purpose Acquisition Company. Samminathan, you're right. Lavanya, you're also right. Geeta, you're also right. Perfect. Question number fifth. Dash is the form of financing in which a company lends money to one of its customers so that he can buy products from the company itself. Personal financing, customer financing, vendor financing, or bill discounting. So the company lends money to one of its customers so that he can buy products from the company itself. Yes, that is called as customer financing, students. The right answer is fifth B. Yes, Saminathan, you're correct. Geeta, you're also right. Question number six, students. Which of the following is not a precondition for qualifying as a startup as per the notification released by the Government of India? Just now we discussed. Incorporated within last 10 years, turnover not exceeding 100 crore, publicly listed companies, and innovation of a product or a process. I think all of you are right. Shailendra, you're right. Geeta, Lavanya, all of you are right. It's publicly listed company, students. I have one more set of questions from interest rate risk management. Let me show that quickly. I'm just sharing the screen. Yes, I hope the screen is visible, students. Perfect. So a company is expecting interest rates to fall would most benefit from which derivative strategies? Okay. Wherein we are expecting that the interest rate will fall. Just a second, let me see the answers who all are answering. Just a second, I have to open the chat box here only. Yes, perfect. Now, this is the question that a company expecting interest rates to fall would most benefit from which derivative strategy, students? One, buy an interest rate cap. Buying an interest rate cap will help in mitigating against the interest rate increase. Sell a floor. Enter into a receive floating, pay fixed IRS. Enter into a receive fixed, play floating IRS. Come on, students. This is a bit tricky question. Saminathan is saying sell floor. Selling a floor means what? Selling a floor means that you are into a borrowing position, student, right? So borrowing position will not help in case the interest rates are likely to fall. The position that is going to help you if you receive floating and pay fixed. So the right answer here is, sorry, um, so in case the interest rates are going to fall, then you are going to benefit from D, which is enter into a receive fixed and pay floating, because you will pay floating, which is a lower interest rate, and receive fixed. Okay. So I think Saminathan, you are right. Second, a bank that has more rate sensitive assets than liabilities is exposed primarily to which risk when the interest rate increases? So, as I discussed, that some of the assets are rate sensitive, which are borrowed or lent on the floating interest rate, right? And the liabilities are also on the floating interest rate. Then they are asking which interest rate are we exposed to in case the interest rate increases. Okay. I think most of you are correct. Saminathan, you are right. Lavanya, you're also right. The correct answer is net interest income increases, right? It will lead to a higher net interest income. Then third, a borrower enters into a pay fixed, receive floating IRS in which I am paying fixed and receiving floating. Which of the following is true? If I'm going to pay fixed and receive floating, borrower is hedging against falling rates. See here, the language is against. Borrower is hedging against rising rates. Borrower will gain when the rates fall. Swap notional effects on cash flows. So, in case I am trying to put myself into a situation wherein I am paying fixed and receiving floating, that means what? That means I am protecting myself against the rising rates, right? So the correct answer is borrower is hedging against the rising rates. Yes, you're right, Saminathan. Lavanya, you're also right. The correct answer is B. The last one, the payoff for an FRA seller becomes positive when forward rate agreement seller, that means the investing position, and it will be positive when the actual rate is higher than the FRA rate, actual rate is lower than the FRA rate, both actual and FRA route move parallel, or volatility increases. Come on, students, this is relatively an easier one. The correct answer here is yes, very good, Lavanya. Saminathan, you're also right. This is the B part where the actual rate is lower than the FRA because you are into the selling position. Yes, Saminathan, you're also correct. Okay, so I think good attempt on the questions. Most of you are correct in terms of the most of the questions. So students, this brings us towards the end of the session, of the revisionary session. Um, so I request the Ashish sir now to please help with the concluding remarks. Thank you,
Uh,
sir. Thank you so much.
Thank you, Devasji. So
Yes,
today you have covered, first of all, you have covered the interest rate risk management. Then you have
yes, sir.
started. So merger acquisition will be continued. It has been
Mergers
over.
and acquisitions we have covered, and
Okay.
startup finance also we have covered, sir. Yes.
Okay. So student, now when we talk about the interest rate risk management, so please note that there are two parts of interest rate risk. One is relating to your interest rate risk. Here in this topic we have covered the change in the interest, volatility in the interest. Okay, so if you link your our if we link our analysis or we have link our study, so there is one part we have discussed in the topic on the security valuation where we have discussed the concept of Macaulay duration. Okay, there we understand how the change in the value of the bond take place due to the change in the interest. Now here we have considered how we can save the change or we can hedge ourselves due to the change of interest. Now there is another part of interest rate risk that is called credit risk, and credit risk means the default in the payment of interest or principal or both. So here what happens for this, if you recall that we use the credit derivatives, and in this we use the credit default swap is one of the very important. Am I correct, sir?
Yes, sir. Yes, sir.
Yeah.
Yes,
So
sir.
you can see that there are topics are generally linked to each other. We cannot discuss any topic in the silo approach. Second, another important point that now there is a term ISDA, okay, International Swap Dealer Association. Now, although the swap is a type of a OTC type of agreement, but still it is regulated by ISDA, and generally in India as well. Generally, these type of agreement are governed by the ISDA. So generally they are the whatever the agreement practically I am sharing with you, because whatever with the interest rate agreement, especially in case of NBFCs, these agreements are very common. So there they follow the guidelines of the ISDA. So it is one of the very important. And another important point I want to share with you, I think Devas sir has also shared with you, the LIBOR is no more in the use. Okay, there are alternative reference rates are there. Of course, in the old books or the old question, you may find the LIBOR, but now LIBOR is no more because there was some scam. Barclays banks are involved in somewhere. So after June 23, they are no more in the use. Now, when we talk about the merger acquisition, of course, there is a spate of the merger acquisition, but now the reverse is also true. That is where the demerger is there. Recently, there is a news of the Vedanta demerger. I think they are demerging into the five company different companies, and it is likely to be somewhere completed by the 30th June, June 26th. So, what is the purpose? Now, I could not recall the name. There is one another company, just a very big American company. They have also have demerged their one company, spin off their one company. Now, when we say that merger creates synergy, so why what demerger creates? So demerger normally creates a value creation, because what happens? See, management is a one. Okay, when the companies is a very diversified or they have a conglomerate type, so they cannot pay the attention to each and every part. So in that case, sometimes it is felt that why not we demerge the unit so that it can work efficiently and value can be bring to the business. So in that case, what happens? The shares are normally get demerged, or they are split into the different shares of the company. So, and startup finance, of course, it is a buzzword nowadays. Startup, now with the passage of time, you will see that if we talk about the startup finance, why startup finance we study? Please note that, student, in the intermediate, we have discussed a topic like cost of capital, capital structure. Now, when we talk about the cost of capital, there are 3 to 4 sources. We generally use the 4 sources, that is equity, preference shares, debentures, and retained earning. Or we can say that equity includes the retained earning. So there are major 3 sources of finance are considered, and generally we compute the WACC, that is weighted average cost of capital, that is used for discounting rate as a discounting rate for the capital projects. Now, when we talk about the startup finance, it is a new concept. Of course, it is not a new concept. It has a very long, in the practice, it was long. Of course, in India, it has come late. Now, when we talk about, see, it is a very, when we will talk about the startup finance, you will see that companies are getting funded which are even in the losses. Because if we go by the principle of capital busting, we will say no, should not accept the project, and even we don't finance this project. But startup finance is the financing of some new idea. It is purely new. Generally, in case of equity, debt, preference share, they are somewhat established business. They are somewhat, we can say that they have some shelf. They have a 15 to 20 years. They are long because they have started with the sole proprietor, then they have moved to partnership, then they have moved to private limited company, now they have moved to the public limited company. But startup finance is contrary to it. It's a very in a generally the business are start on say somewhere around 2 to 3 years back, and they somehow come out with a even IPO. So for startup finance, one of the very important point is to be note that exit route is very important. Okay, so for exit route, what is the exit route? Mainly it is the IPOs. So then it comes into the IPO, then it comes the cost of equity concept, etc. So, but before that, we can say that it is a kind of a nascent financing, or we can say it is the initial financing. So nowadays, startup finance in very picture, and we can say that it is a one of the very buzzword, and even the new generations are very much using this terms of finance. So Devas sir, thank you very much for sparing your precious time and enlightening the
Thank you,
student.
sir.
And if you want to
Thank you.
add something to my, or what I have, correct me, any my points
No,
will
no,
come
sir.
for free.
No, no, sir. Absolutely agreed, sir. Absolutely
Okay,
agreed.
okay.
Thank you.
Okay, student, thank you very much for your patient listening. So see you in the next class with a new topic. Thank you, Devas sir, once again, and thank you, student,
Thank
once
you.
again. Thank
Thank
you.
you, sir.
Have a nice
Thank
day.
you. Thank you. Thank you. Bye.